Hey, Dr. Crosby, welcome to the His and Her Money Show.
Thank you. Thanks so much for having me back.
Yeah, we are super glad to have you back here. You blessed us a couple years ago. We talked about the laws of wealth, which is super powerful. And we'll be sure to have a link to that previous episode in the show notes of this episode. And so we are super glad to have you back here to really share your insight and knowledge on a topic. I don't think there's enough conversation around. We talk about investing, but not the psychological, sociological aspects of how we make our investing decisions. And so we're super glad to have you here again. But for those who are hearing you, seeing you for the first time, are unfamiliar with your work, can you just say hello to everyone and let them know what you are all about?
Yeah, for sure. Daniel Crosby. I'm a doctor of psychology. Found my way into the world of finance. My dad was actually a financial advisor. So I grew up in a house where financial topics were very much top of mind. They were discussed around the dinner table. We talk about investing and equities and, saving. And I joke, it's not a joke, it's the truth. Debt was a four-letter word in my house growing up. I grew up in a conservative religious household, and my dad wouldn't let us swear, of course, but then wouldn't even let us say the word debt. So money's always been a big part of my life. And so entered, got a degree in clinical psychology with an eye to being a therapist. And, long story short, found out that I loved talking to people about their financial woes, perhaps more than I did their other life woes. And so found myself into this world of behavioral finance, which just studies basically how psychology impacts decision-making around money.
Awesome. So, let's go back to your story there for a second. How did being raised that way where you couldn't even say the word debt, how did that shape your personal philosophy as you went into adulthood and the way that you interacted with money?
Well, I remember being a kid and many young boys, I was really into cars. And so you'd be driving around and you'd see a flashy car and you go, oh, Dad, look at that car. How cool. They must be so rich. And my dad would say, son, that's a substitute for wealth. The money that they spend on that car, that's a substitute for wealth. Real wealth is quiet. It's sleepy. It's what you don't see. It's what's sitting in a bank account or an investment account, quietly earning you more money. So I got a real good education from a young age about sort of a Warren Buffett style approach to letting your money work for you, to working hard, to paying yourself first. I remember my dad gave me The Richest Man in Babylon when I was a kid, still a classic book, but, paying yourself first, letting that money make you more money. And really, my dad and I are both people who don't put family first, try and put family first, and who don't want to let the world distract you from the things that matter most. And so for me, that's what true wealth has always been about, is setting aside money, letting that money work for you, and then being able to say no to anything that would distract you from your mission in life or what's most important to you.
Wow. Now, I know you're a husband and father of three. So do you find yourself imparting similar types of wisdom to your children?
No, absolutely I do. And, I think we've made a special effort with my daughters. I have 2 daughters and a son. And I think women in particular don't get enough, coaching and counsel around power, around how to be powerful with money, how to let money work for you. And so, my 10-year-old daughter owns Nike stock. She owns Disney stock. And so anytime, we're out and about, we're shopping, we're growing through the day, we're talking about the mechanics of Chick-fil-A where we're having dinner, like how do they make money? What are their margins? How do they differentiate themselves? Could you own a piece of this? With Chick-fil-A, you can't, unfortunately. It would be a great investment. But could you own a piece of this? Could your money work for you? And I find that children have a real natural thirst for this sort of thing. I mean, they're sharp and they want to know about this. And when those dividend checks come in, when they see those dividends that they got money, just for being patient and staying the course, it's really a powerful thing.
This is a very, very interesting turn in the conversation. So, we have a ton of parents listening right now, and that probably spark something in them. Do you have any like practical, like how do you allow your children to invest? Like, is there a certain special account for children? Is there a certain special platform? Like if a parent's listening, like, man, you know what? I should have my kids try, investing at an early age, even if they don't get it right, I can monitor, I can help them think through it. So like, do you have any wisdom around that?
It's actually a business opportunity, I think, for someone who's listening, because it is a little bit hard. Like, I mean, it's a little bit hard to get. For us, it's just, an E-Trade account, but it's a little bit difficult. And some of these shares are quite expensive. If you look at, Disney shares or Apple shares or some of these things, if you're just trying to buy one stock, it'll set you back a couple $100, $1,000. And so I think there's an opportunity there for sort of fractional investing for young children. But, one thing that I've done is I've taken to giving new parents, when new parents they have a child, I'll give them a check for the amount of one share of an all world equity ETF. And I'll say, look, go open an account for your baby with this, whatever it is, $87.12 I just gave you. I give it to the penny, right? So I think last I checked, it was about 87 or 90 bucks. Give them this check, say, go open your kid an account, buy them one share of every equity, basically every equity market in the world. And by the time they retire, this should be worth about $30,000. And that just, if historical trends keep up, it would be worth about $30,000. So, I mean, that's better than a blanket, right? That's better than, better than a pacifier. So there's no super easy way to do it outside of just how you would do it with an adult. But then in terms of how do you talk to them about it, I just look for natural teaching opportunities, which are everywhere if you start to look for them. Like I said, we're at Chick-fil-A. And I said, look, why do we go to Chick-fil-A versus McDonald's, right? Why do we eat here? Well, they have healthier options for mom and dad, right? Why else? What about the friendliness of the people you interact with, right? It could be a million things. Kids are thirsty for this. They're sponges. And it takes investing out of the ether, right? It takes investing out of this thing that exists for only really rich people, that only exists on Wall Street. You have to be a maths genius to do any of this. And it takes it back down to earth, so that they can get started at a very young age. I tell my kids, if you want to retire when you're 65, let's say you want to retire with $2 million. On average, if you start saving when you're 22, you can save $6,000 a year and retire with $2 million. If you wait till you're my age, if you wait till you're 40, you got to save $27,000 a year. That's really tough to do. Most people can't pull that. So time is on your side. So look for those natural opportunities to teach kids about business and investing.
Wow. Can you say the name of that fund one more time? The World.
So I don't even remember which one it was, but it would be like a Vanguard all world equity fund. So it would basically be Europe, Asia, US, Canada. It would own pieces of all of the stock markets in the world. Yeah. And so you just say, look, over time, it's done about 7 or 8% a year. That, $100, 7 or 8% a year, it's going to double every 10 years. You're going to have some real dough there by the time you're set to retire. And it's a powerful way to get kids started, I think.
Wow. This has been awesome. Now, we need help too, as the adults in the situation, right? It's great to get our kids off to a wonderful start with investing, but some adults they did not have the type of lessons imparted to them that your parents imparted to you. So they're 30, 35, 40, just now trying to figure out the investing game. And I think that when we're at that point in our life, we are looking for strategy. We are looking for recommendations. We're not necessarily thinking about behavior. We're not necessarily thinking about other factors outside of dollars and cents that we should be looking at, considering as we're trying to create an investing strategy for ourselves. Why do you think this is so overlooked by us, especially if this is something that you're endeavoring to for the first time?
Yeah. Well, There's a couple of reasons. One of them is that Wall Street has marketed to us for a very long time in a very bad way. Wall Street has marketed performance to us and has said, look, we're going to put you in this high flying fund. We're going to get these eye popping returns. We can see the future, and you're going to cross the finish line of retirement by virtue of these really high returns that we're going to get you. Well, the internet comes along, people start talking, and we go, oh, like, this hasn't really been happening, Wall Street, right? You know, you haven't been delivering perhaps the returns that you told us. And so things are starting to change, and we're starting to understand that discipline and behavior are far more predictive of whether or not you cross the finish line than getting, you know, invested in the right funds. Let me give you an example. If you could have picked in the 2000s, if you could have picked the best performing mutual fund of the 2000s, and you had known from the beginning, the end, if you'd known the end from the beginning and said, yep, this is the one, and you had invested in that, that mutual fund returned 18.5% per year over from 2000 to 2010. So that's absolutely incredible. Like, you would have doubled your money like every 3 years. But the average investor in that mutual fund had a negative realized return. So how is it that a fund that's doing 18% a year has negative average returns for the average investor? It's because what happens is it was a concentrated fund. So the fund takes off, it does really well, it gets in the news, people hear about it, they pile their cash in. Well, then, like all funds, it has a period of underperformance, it struggles for a bit, and people go, oh, well, that was dumb. So they jump out, right? Then it takes off again, and the people go, oh, well, maybe I was right the first time. And they pile their money back in. And then it goes back, you know, comes back down to earth, and they jump out again and rinse and repeat. So the best mutual fund of all, 18.5% a year, and the average investor in that had a negative realized return. We have to understand that, first of all, we can't see the future. You can't know today what mutual funds or ETFs are going to do well tomorrow. But even if we could, your ability to profit from that is predicated on your ability to take that ride. And that is far more indicative of whether or not you'll reach your goals than being a math genius or knowing a bunch about finance.
Wow. So if I understand that correctly, it's not the vehicle. The vehicle did what the vehicle was supposed to do. It probably exceeded a bunch of expectations of what it was supposed to do. But most people who were in the vehicle couldn't stomach the ups and downs and kept going in and coming out. And when you go in and out, there's fees, there's transaction costs and things like that. So at the end of the day, or at the end of this studied decade, although the fund was outstanding, the individual didn't get outstanding results because of their behavior, not the fund.
That's right. You said it perfectly.
Wow. Okay. So how do we take a hard look at ourselves? That's one of the toughest things to do. If you're talking about money, if you're talking about health, if you're talking about relationships, it's hard to look in the mirror and figure out what you need to do differently. How do we do that when it comes to this?
Yeah, no, so you're absolutely right. I'm working on a new book I started this weekend that's about getting to know yourself, because it's hard to take that hard look in the mirror, right? So frankly, most of us tend to over rely on willpower. We go, okay, I'm going to do the right thing in the right moment because I'm smart and I'm disciplined and, you know, I know what to do. But, you know, some of my research has shown that the average investor loses 13% of their IQ when they're under financial stress.
Wow.
So yeah, right? And some of us, look, man, I went to Alabama public schools. I don't have 13% extra hanging around. I need every little bit. So, you know, the trick here is this. It's not to rely on thinking that we're going to do the right thing in the right moment. It's automating good behavior. So one of the best predictors of whether or not you're going to reach your retirement goals is if you automate the withdrawal from your account every 2 weeks, right? Don't even think about it. Never see the money. Because some people think, you know, I'll just set a little aside. I'll see what I need and I'll set a little aside. You won't, right? You won't do it. It's like going to a donut shop when you're on a diet, right? Don't do it. Just automate the process of saving every month. That's one huge thing. Another huge thing is to lead with your why. Lead with your why. Lead with the thing that matters most to you. You know, for me, it's spending time with my family. It's spending time with my wife and kids. And so when work starts to wear on me, when I get tired of the grind and the travel and all that, I have to sort of recenter myself on the big picture, on the goal. And that's going to help a lot. And, you know, working with an advisor can also be really helpful. Working with the right advisor, because that person's going to keep you on the straight and narrow. They're going to keep you doing what you ought to do. So automating, keeping that why front and center, and then getting the help you need, whether it be by working one-on-one with an advisor, listening to podcasts like yours, or whatever it may be. Those are just three powerful things I think you can do.
All right, I want you to analyze me, all right, the 22-year-old version of me, because here's what happened. I was in a bunch of debt and made a bunch of mistakes because, you know, I was in the military, so I left home at 17. Now I have income that I've never had before, and I got into a world of trouble. And then, you know, on the other side, when I really got frustrated and fed up with it, I started reading books and reading articles. Podcasts wasn't really happening back then. YouTube wasn't really as big as it is now back then. So it's like books and articles on like Yahoo Finance or Motley Fool or something like that. And so I kept seeing, hey, you should be investing in mutual funds. So I did some research locally, went and invested in a mutual fund. And I did the automated thing to where I wouldn't have to think about it. I set up what do they call it? An allotment. So it went from this dollar amount went from my paycheck to the fund. But what happened, Daniel, was I would get those statements in the mail, right? And I would open up the statements. I'm like, man, this is not working. Why you can see the amount that you put in and you can see what it's currently worth. And sometimes what it was worth was lower than I put in. And I was like, man, this is not working. This guy must be a crook. And I ended up jumping out probably only 3 months into the game. So it might be somebody who I don't want them to make that same mistake. Like I want them to, you know, have a better experience. But what should I have done differently? Should I have not read those statements? Should I have not put so much emphasis into it? You know, somebody who's listening right now who is about to launch out, they're probably gonna go look up the fund that you mentioned earlier, jump in the game, but you know, they're gonna get those statements in the mail or email statements nowadays. How should they handle that?
Yeah. So one of the things that I do, so first of all, I take my statement every month when it comes and I shred it. I don't look at it. And like, look, this is important to understand because look, I've written 3 books on the psychology of money now, right? I'm a doctor of psychology. You would think that if anybody can handle it, it's me, and I can't handle it. Like I take that thing every month and I just shred it. I don't even look at it because I'll be 40 this year and I got 20 or 30 years of working left in me. It's not even close. Like I don't need to look at it. Right? I don't need to look at it. So that's one thing that I do. The second thing is you have to understand how markets work. So over time, a diversified portfolio, so this would be stocks, bonds, you know, US stocks, Asian, European stocks, just everything, right? Cash, that's returned about 7% a year over long periods of time. Over, say, a 30-year period, on average, you're going to get about 7% a year, which is really nice. That means that your money's going to double about every 10 years. So yeah, if you hang on for those 30 years, your 100,000 is going to become 200, then 400, then 800. That's pretty good, you know, for taking that ride on average. But within those years, like the 30 years looks good, but on any given year, this is what it looks like. If you look at the past 35 years, the average intra-year drawdown, so that means the average max dip in the stock market in any given year, is 14%. So in any given year, you're going to lose about 14% at some point during the year in the stock market. Now, the market has closed up for the year 27 of those 35 years. So it is an absolutely wild ride. You look at Q4 of last year, we were down like 15, 16, 17%. But you look at the first 2 quarters of this year, we're up about 15, 16, 17%. So it's really, really kind of a wild ride. So the less you can look, the better off you're going to be. And, here's another stat that I'll kind of close this part out with. If you look at the market every day, which you can on your phone, right? I mean, the stocks app is right there on your iPhone. So if you look at the market every day, the market's up about 55% of the time, each day, and it's down about 45% of the time. Okay. So it's nearly 50-50, but it doesn't feel 50-50, right? If your spouse tells you, hey, you look nice today, and hey, your hair looks stupid or whatever, if they give you one compliment and one slight, like they don't weigh the same, right? Like the compliment doesn't feel as good as the slight feels bad. And it's the same with the market. The 55% that it's up does not feel as good as the 45% that it's down feels bad. But if you look once every 10 years, there's only been one 10-year period in the history of the stock market where it's ever been down at 10 years. And that was sort of the lost decade of the early 2000s. And so the less you can look, the less scary it's going to be. So that's what you got to go back in the time machine and tell your 22-year-old self.
Thank you. Now, you talked about a lot of things that psychologically we need to be aware of and do after the decision is made, after the investment's made. Is there some work, some inspection that we need to do within ourselves as we're making a selection? We're looking, we just got our packet from HR. We're looking through all the different fund options that we could potentially invest in with our 401k or 403b or 457. I know in your new book, The Behavioral Investor, you said there's a lot of external factors that come into play that we may or may not be aware of in our decision making when it comes to selecting investing options. Any advice for us there on the process of selection and what we need to be aware of psychologically?
Yeah. So in my books, I write all about how to kind of get into the nitty gritty of stock picking and how to create these super concentrated, cranked up portfolios. The average listener to this show needs to know none of that. You don't need to know any of that. Like the average person, that is so far from what you need to be worried about. So Morningstar, this big data analytics firm in our space, came out a couple years ago with a study. They looked at all the factors that predicted success, the success of ETFs and mutual funds. And the number one best factor for predicting the long-term success of a fund was how expensive it was. So if you're looking at one thing, you want cheap diversification, right? You want to own the world. You want to own stocks and bonds. You don't want to be all US. This is like a big mistake people make. You want to be in a multi-asset class portfolio, which means US stocks, foreign stocks, bonds, maybe some other things, right? But at a minimum, US stocks, foreign stocks, and bonds. And you want to get that exposure as cheaply as possible. So that's for the average person. That's all you need to worry about. Don't get fancy with it. Don't get fancy with it. Pick a nice target date fund that's cheap and ask about the expenses. If you don't understand the expenses, ask until you do understand. Ask HR, ask whoever, do the digging you need to do to understand those expenses, because the average person doesn't understand that, like, yeah, these funds, they're charging you, like they're taking a percentage, they're taking a percentage of that wealth you've invested, which is fine. Like they got to eat. There's nothing wrong with that. They're doing a service, but you want it to be as small a fee as possible for the diversification.
Yeah, and a great resource on the expense ratio and the difference that it can make is a PBS documentary called The Retirement Gamble. I highly suggest everybody that is listening go and check that out, because, man, they do a good job of breaking it down. And it really is everybody that we've sent to watch that, and it's totally free. It's you can Google it, and we'll have a link in the show notes. But it is so mind blowing how, you look at it, if you look at your fund options, it might say the expense ratio is 1%. And you're like, oh, that doesn't sound so bad. I mean, 1%, that means there's 99% coming my way. And that's so wrong. It's so the math that they give, the examples that they give, because, a company like Vanguard, instead of paying 1%, you're paying 0.2% or 0.04% or something like that. And it's such a monstrous difference. So Dr. Crosby is absolutely right. Please understand expense ratios and the devastation it can cause if you don't pay attention to it. Now, you gave some good advice on, and it's something that I haven't heard a lot of people say. I've heard people say you should be, because we talk a lot about index funds and the importance of that. That's what, Ty and I personally do. And so we understand that you should do some stock equity indexes as well as bond indexes. But not a lot of people have said, hey, you need to be looking at foreign market indexes as well. So are there certain ones are like, if you're going to delve into, looking at that as well as, the total stock market index fund or the total bond market index fund, like what are some things to factor in as you're researching the different index funds that are from foreign markets?
Yeah. So again, you want to keep it as big picture as possible. And I'm not going to recommend compliance. Yeah. Compliance will yell at me if I recommend specific funds, but I will tell you as a general principle, you want to hold equity in your portfolio roughly as it's represented in the world. So let me break that down a little bit. If you look at the world economy, the US is about 55% of the world economy. Okay. So your stock holdings, roughly 55% of them should be in the US. Now, if it's 65 or if it's 50, like whatever, right? But as a general rule of thumb, about 55% of your holdings should be in the US. So where's the rest of the business happening in the world? Well, primarily it's in Europe and Asia, right? There's some in Australia and other places, of course, in Africa, but primarily the big dogs are Europe and Asia. Now, all sorts of reputable fund companies are going to be able to give you exposure to all of Asia and all of Europe. I would not, for the average investor, be making bets on specific countries. Like, you don't need to go parse, whether the Philippines is better than Malaysia, no. Just get broad, exposure to Europe and Asia as well as the US, because there's something called home country bias, right? Where we feel like, because we're Americans, that we know more about the American market and therefore it's safer because we're more knowledgeable about it. But the tricky part is, if you live in a country, right, you're already taking a big bet on that country, right? Your job is hooked to that country. Your house sits within that country. So if that country falls on hard times and you're 100% invested in that country as well, you're sort of triple stacked. You've got, your livelihood, your real estate, and now all of your, investments are in that one country. I think it's a better time than just about ever before to try and get some exposure to the rest of the world, because the U.S. has been on such a tear for so long. The U.S. has led the pack for about a decade, and trees don't go to the sky, right? Like nothing lasts forever. I mean, God bless America. I love it. Best country in the world, but like we're not going to be the best year in and year out. And so you want to get exposure to other places.
Yeah. Agreed. Now, we talk heavy psychology here because that's your specialty. And I know for some people, they disqualify themselves. Like, they hear what you're saying, but then they'll immediately disqualify themselves as being unable to do what you're saying. And that could be for a number of reasons: lack of information prior to this, lack of examples in their life, lack of access to, or maybe within themselves, a lack of trust. How do we fight through those psychological factors and not allow ourselves to continue to disqualify ourselves from becoming investors and building wealth, not just for ourselves, but for those that are coming behind us?
I think it's a fantastic question. I would give two answers. I think the first answer is to invest in yourself. A lot of people say, I don't have money for this. Like investing is a rich person's game, and I disagree. But I don't disagree that at certain income levels, it's hard to have anything left over to invest. And so read a book, go to night school, go back and get the master's degree, whatever that looks like for you. An investment in yourself pays the best dividends of all. It's going to make you happier, healthier. It's going to move you up in the world. You can't invest until you have discretionary income. And so an investment in yourself is the best investment of all, better than any of these ETFs we've talked about today. The other thing that I would tell folks to do is to just get started. I write a lot in my books about how money compounds, of course, but more importantly is that good behavior compounds. If you can start doing something, even at just a small incremental level, that behavior becomes familiar. It becomes addictive in a good way. Like I'm so addicted to saving money right now. It's crazy. It's just because you get a rush, right? And I started small. So whatever that behavior is, if you're setting aside $25, and it may not seem like much, but whatever that is, get started, let it become comfortable, let it become familiar, teach yourself incrementally, and let that behavior snowball. Because as surely as wealth compounds, good behavior compounds. And it can't do that until you take that first step.
Great advice. And a book, like you said, we should at least be investing in ourselves in the form of books. Like that's something that no matter your income level, you can get a hold of. Tell us more about your new book, The Behavioral Investor, because again, we're all investors and we all have psychological, sociological factors that are helping us, hurting us when it comes to making sound decisions. So tell us more about the book and where we can pick it up.
Yeah, so the book, like you said, I felt like we hadn't really addressed some of the sociological factors, some of the neurological factors. So there's the whole first third of the book is pretty nerdy. It's talking about the brain science of how you make decisions with money, how the people you surround yourself, the societies in which we find ourselves, how they impact our money. In the second part of the book, I talk about the 4 sort of primary psychological errors we make as a result of our societies and our brain chemistry. And in the third piece, I talk about sort of what to do about it. So the easiest place in this day and age to find any book is probably Amazon. So pick it up. The Behavioral Investor, pick it up. It's just named the best investment book of the year, and super proud of it. So hope folks enjoy it.
There you go, guys. Best investment book of the year. Let's get it. Are you active on social media? People want to keep in touch with you?
Yeah, if you want to yell at me, find me on Twitter at Daniel Crosby, or I'm also very active on LinkedIn, just Daniel Crosby, PhD.
All right, we'll be sure to have those links in the show notes of this episode. Dr. Crosby, this has been extremely informative and helpful. We really appreciate you making some time in your busy schedule to share with our audience today. Thank you.
My pleasure. Thank you.